Non-banking financial companies primarily earn through what is known as the interest spread. The spread represents the difference between the rate at which the institution borrows funds and the rate at which it lends those funds to customers. Unlike manufacturing firms that generate profit from selling goods, this model depends on financial intermediation. For example, if a non-banking financial company borrows from banks or through debentures at 8% and lends to retail borrowers at 14%, the gross spread is 6%. However, this 6% is not pure profit. It must cover operating expenses, credit losses, and capital costs. The net interest margin measures interest income minus interest expense relative to earning assets. But overall profitability depends on how efficiently risks and expenses are managed. Therefore, sustainable earnings require disciplined pricing and careful risk selection rather than simply charging high interest rates. Let us understand this through a structured numerical illustration. Assume a non-banking financial company has a loan portfolio of 1,000 crore rupees. It borrows funds at an average cost of 9% and lends at 15%. This creates a 6% gross spread, generating 60 crore rupees in annual gross interest income after funding cost. Now consider operating expenses of 2% of assets, which equals 20 crore rupees. Further, assume credit losses of 1.5%, amounting to 15 crore rupees. After deducting operating expenses and credit losses, the remaining profit before tax is 25 crore rupees. Notice how the initial 60 crore rupees reduces significantly once real risks and costs are recognized. If credit losses rise to 3% during economic stress, profit falls sharply. This example shows that profitability is highly sensitive to funding cost, asset quality, and operational efficiency. It is important to understand that headline lending yield does not equal financial strength. A portfolio yielding 18% may appear attractive, but if borrowers are high risk and default rates increase, actual returns may decline. Risk-adjusted spread considers expected credit losses, collection costs, and capital buffers before determining true profitability. For instance, during periods of liquidity tightening in India, several non-banking financial companies faced rising borrowing costs. Those that expanded aggressively into unsecured lending without pricing for risk experienced margin compression and stress. In contrast, institutions that align growth with stable funding and rigorous underwriting preserved profitability. Expansion strategies must therefore balance yield, funding stability, and portfolio diversification. Sustainable growth comes from managing asset-liability dependence carefully and ensuring that each new loan contributes positively after adjusting for risk and operational cost. Long-term value depends on disciplined spread management rather than rapid balance sheet expansion.